We are joined now by Tyler Dickson. He is the co-head of banking, capital markets, and the advisory division at Citi. Good morning to you. How do we think about these two pictures? The IPO picture on one end, the deal-making picture on the other. There was a view, by the way, that private equity and others would be jumping to buy lots of these companies that were challenged and struggling, and maybe they haven't been as challenged.
I think there's a real difference out there. We see the capital markets being quite resilient, right? We've navigated the period of market volatility successfully. Right now, market fluctuations have stabilized significantly in the second quarter. So we have seen record levels of debt issuance, particularly investment-grade debt. Q2 was an all-time record. We've looked at a broadening out of activities in the equity capital markets and into the leveraged loan space more quickly than we anticipated. The capital markets have shown a significant amount of depth and resiliency. We hope that continues, but we're very pleased with that environment. That has really allowed things like the IPO market to become much more active than was anticipated. So Q2 has been a story where we've seen more IPOs, a heavy amount from tech and biotech, but broadening out across many sectors. And as you've said, we've seen 40 IPOs greater than $20 billion since the crisis hit. And 35% of those IPOs have been priced above expectations. And the first day after market is averaging about 40% up. And so there's a constructive view of the capital markets. And the M&A market usually follows the equity market.
Yes and no. Sometimes the M&A market is sort of a backward indicator of where things are. But let me just ask you this then. On the M&A side, is the problem valuations in a market where the stock market is going up every single day, right? I assume if you're a CEO either thinking to sell, you're thinking maybe I should wait because maybe my stock is actually going to be higher. And if I'm a buyer, you're thinking that these prices are getting out of whack.
I think both are on the minds of CEOs and of boards, but I think corporates are agile. They moved quickly to secure liquidity at the front end of this crisis. And they're all focused on business resiliency right now. So are their supply lines diversified enough? Are their supply lines too long? How are they thinking about delivery and purchasing? How does the demand curve change post-COVID? And how should they be reacting? In our view, there's both opportunity for defensive M&A, where we're seeing green shoots. What are we talking about there? Companies preparing in advance of activism or potential private equity moves, asset sales. What are we talking about when we think about offensive M&A? Winners.
Tyler, but what do you think about valuations?
I think valuations are underpinned by the unprecedented stimulus by governments around the world, and I think increasing confidence, as Mr. Kramer suggested, about reopening economies. Both of those dynamics are pushing valuations higher. I think we will naturally, given the environment, see a lot more careful deliberation in the M&A market, but I think that is on the come. I think it's natural in this environment.
But I think what I'm asking, Tyler, when you're making presentations to the boards of your clients and you're running through your comps relative to other companies and you're looking at the valuations over the last 12 months, you might even be looking at over the last 36 months, typically when some of these board presentations get made. Are you looking at these valuations and saying, this makes a lot of sense, folks? Or are you saying, you know what, wait, because I think these companies are going to be a lot more challenged 6 months from now, or I think the price is going to be through the moon in 6 months and you got to act now?
In this environment, it's very difficult to predict the future. I think companies are looking at the opportunity both ways, and they need to be prepared to do transactions that are sustainable over the long run. When you look backwards, the fact that the S&P is within 10% of its valuation pre-COVID, that might give you reason for pause. When you look out to what's the expectation of a recovery in economies around the world in 2021 and beyond, you have to think long-term in this M&A environment.